Well, welcome to what I think will be our final virtual event of this year. Hopefully not the last one forever, but also hopefully next season, as it were, we will be able to do a few more of these in person. Now, I have to apologize again for our failed attempt of a fortnight ago. We have applied a lot of duct tape this time in the hope that everything sticks together through the next hour. So thank you very much for persevering and joining us today. I'm really delighted to see you all here. And of course, our three panelists, Elroy, Dimson, Lauren Smart, and Robert Gardiner, who will help us unpick the world of responsible investing today. In a moment, I will let each of them introduce themselves because they will do that so much better than I will. But let me just firstly run you quickly through some housekeeping. We are running this event as a webinar, so you are all muted and we can't see you on screen. With a number of attendees, we would all become tiny little specks and it will be difficult to see our panelists. We are planned to last for about an hour. The structure will be that Elroy will do a brief presentation to which Lauren and Robert will respond. We can take it then in a form of an open discussion. Please do ask questions through the Q&A or through chat. But if you can, kind of think about towards the end of the various presentations so they don't get swallowed up in the traffic on the chat. And finally, just a quick reminder that we are recording this session as we normally do our webinars. So without much further ado and more from me, can I hand over to Elroy, please, to introduce himself?
Well, hello, everyone. Glad to meet most of you for the first time and one of you for the second time, the one person who was successful in getting into our failed attempt 2 weeks ago. I'm honoured to be participating in this group with Robert and Lauren, and thank you, Masha, for setting this up. And Caius, who is hiding in the background, but who's also done quite a bit of the legwork. I'm based at the Judge Business School. I've been there for 13 years, and before that I had a long career at London Business School. My area is finance, with a particular interest in investing and in investing for the long term. That's the area in which I've worked, and it's taken me in two directions. One direction is looking at long-term asset allocation and strategies. And the other one is focusing on responsible investing, defined broadly. This is something I got taken to through a role which I had with the Norwegian Sovereign Wealth Fund, which took me into the role of formulating for the Strategy Council a strategy which would be deemed to be responsible by the owners of that fund, who are 5 million Norwegians. So I've kept my hand in a little bit in what we in academia call the real world. It's the one that most of you occupy. But I also research and publish in this area. What I thought I'd do is share a few remarks. I've got six slides, no equations, and share some thoughts which might kick us off. I can't cover all of the topics that I'd like to in the time. So you'll be relieved to know that it's just a few pictures and diagrams that I want to share with you. So let me kick off by showing you a couple of slides, which, one moment. Where am I? I'm not getting the option to share. Yes, here we are. This is reappeared. And so I'll show you what I wanted to share, starting hopefully here. My career was for a long period at London Business School, and there was a keen young math graduate there who was starting up an information service for a faith-based charity. His name was Peter Webster. And so he created what, at least in Europe, was the first formal provision of responsible investing information for investors. His service was called IRIS, E-I-R-I-S. This is a field which has grown a great deal. There was a survey done by a master's student at Oxford University not long ago, and she reported 500 different E, S, and G, that's environmental, social, and governance rankings, 170 different indices, 120 standards. Jim Hawley, who's an old hand on writing about these topics, is at an organization now called True Value Labs. He identified 600 products, 150 investment organizations. So from one organization, the numbers have grown a great deal. One of the organizations that brings together like-minded organizations and individuals is the Principles for Responsible Investment. And looking very recently at their website, they have a new segment up there called the Academic ESG, Environmental, Social and Governance Data Review, which provides a tool for filtering out the data sources used in academic studies. And it gives considerable detail on 238 unique data sets that people have used for research in this area. So this is now an area where, instead of there being no information, but perhaps one emerging bit of information on the left of the screen, that we are something of the order of about 1,000 service providers to this community. It has become very important to many people what the sort of ethical and environmental and social standards are of the funds that look after their assets. And that's given rise to a growth in rankings and rating systems. Two of the most popular are Morgan Stanley Capital International, which is a Swiss-based firm that it would now be regarded as American, the ownership being Morgan Stanley, and Sustainalytics, which started out with a commitment to looking at responsible investing in a broad way. And they provide data on different companies. And so I and two co-authors have looked at a number of different dates, a number of different pairs of them, at what the ranking looks like for different providers. So we take from the best to the worst for each of them, and we plot them in a scatter diagram. And so you can see in the bottom left, there's slightly more cases where Sustainalytics thinks a company is poor, and so does MSCI. And on the top right, you can see the same sort of story, slightly more that are thought to be wonderful by both services. But the predominant picture you get from this is that there's very close to no relationship at all, very little correlation between what MSCI and Sustainalytics have to say about the companies that they monitor, in this case, US companies. You find the same thing for other countries. So just focusing from the broad picture to the narrow picture, focusing on individual companies, I've picked out 6 companies to give an illustration of that. I've moved from MSCI and Sustainalytics to also bring in FTSE, which FTSE Russell, as it's now known, which is one of the providers of ESG data, which is owned by the London Stock Exchange. And here you can see right at the top some ratings for Facebook. So you can see for Facebook that Sustainalytics thinks Facebook on environmental grounds is just awful. And MSCI think they are pretty wonderful, almost at the top percentile. On the other hand, if you look at the social rankings on social criteria, then if you have a focus on working practices, child labor, and so forth, MSCI think that Facebook ranks very low, and Sustainalytics thinks they rank very high. So let me just show you a couple of other examples. Here we've got 3 others which contrast quite a bit. JP Morgan what you can see with the green solid circle is that MSCI think they are very poor. But on the other hand, Sustainalytics think they're very good. If you look at the next row, you can see the governance scores. Wells Fargo has allegedly poor governance, and Sustainalytics thinks that Wells Fargo is well governed. Or if you look on the bottom right at Pfizer, you can see something similar, MSCI at one end, and you can see that Sustainalytics is at the other end. So let me move one step forward. We've got environmental and social and governance scores. These are combined together with proprietary procedures into overall scores. Here's Wells Fargo, and you can see that Wells Fargo is thought overall to have a pretty poor record when it comes to MSC's evaluation of them. So MSCI have got them towards the left. That's over here, where I'm showing you just with the pointer. And towards the right, you can see in black that FTSE think they're pretty marvelous. So the dilemma one has is that these firms put huge amounts of effort into their rankings. There are large numbers of smart people who are working on them, but they have different frameworks, different approaches, and I'll touch on these in a moment. And so you can't just delegate to a data provider. You need to be much more thoughtful about what they're doing and whether it meets your needs. That scatter diagram that I showed you earlier, we can capture that with a correlation coefficient. So the ESG ratings that we would see if we compared, first of all, in darker but not very dark blue, FTSE with Sustainalytics. If we look at all of the companies for which we've got data, this is again based on US data, there's a correlation of under 0.6 between what FTSE says and what Sustainalytics say. Of under 0.5, if we're looking in the dark middle bar, that's a comparison between MSCI and Sustainalytics. And the light colored one is a comparison between MSCI and FTSE, and that's a correlation of under 0.3. Now, each of these ratings is a combination of the underlying E and S and G score. And so we can look at those separately. The correlation between the first pair, FTSE and Sustainalytics, is about 0.4 when it comes to environmental scores, about 0.1 when it comes to the MSCI Sustainalytics duo, and MSCI and FTSE have a correlation of only 0.2. The social scores show a similar degree of dissimilarity. And finally, and perhaps most shocking, is governance. Governance ought to be easy to deal with. We have criteria like, is the chairman a separate person or the same person as the chief executive? So we have pretty hard sorts of rules there. And yet, what we see is there's just about zero correlation on the right-hand side on the governance scores between major providers of these rankings. And yet, if there's something which you treasure, in this case, responsible investing and ESG criteria, if you treasure it, you should measure it. And so the solution is not to walk away from the data providers, but to understand their divergences. And some of those divergences are sometimes to do with data discrepancies, sometimes to do with the choice of benchmark. For example, one index provider looks at how good you are within your sector rather than what you look like when you compare across sectors. So you can be highly rated as a tobacco company if you're compared with other tobacco companies, and lowly rated if the benchmark is companies as a whole. Or another issue that arises is, what do you do where data is missing? This is a widespread problem. So as a provider of these scores, you could decide that you'll put in a 0 if you don't have any data, or you could put in a number which is the average of all the companies for which you do have data. But of course, when you don't have data, there may be a reason for that. There may be just extraordinary information overload, which means that you've got to pick and choose and use judgments. Or there may be a difference in the weighting scheme. I'll just illustrate that. So here you can see for MSCI and Sustainalytics, what weight they give to environmental and social and governance scores. On the one hand, with Sustainalytics, the leftmost bar, the bar beside it, which is MSCI. So you can see for that one, the social factors get double the weight that they get with Sustainalytics. Or if you look at technology hardware, you see something similar. Food retailing, again, dissimilarities in the weighting. So not only do these underlying scores vary from provider to provider, but the way they're weighted vary. Look at the insurance industry. So here you can see that 3/4 of the score for environmental, social, and governance factors altogether is driven by the social ranking. Or if you look at all industries as a whole, you can again see variation. And you see this variation as you compare different providers. So those numbers can vary a great deal. They can be double in one case compared to another. What is the performance like of following these indexes? If you look at the launch date and roll forward, we plot in each case the difference between an index which is screened to be high in its integrity along ESG lines, and we deduct the parent index, which represents all of the stocks which could have been an ESG index, regardless of the ethics and responsible nature of the company. And on average, for the two major indices that are used in this industry, FTSE for Good and MSCI's ESG index, what you can see is performance is pretty neutral. If you start with a score of 100 and you look at the stock market performance of mimicking that index, you'll find they end up rather similarly. The Dow Jones sustainability indices have drifted down. That's a less frequently used indicator as to how to put the portfolio together. What is intriguing is that we don't have a back history for MSCI, but we do have a back history that was constructed for the other two. And it's intriguing to see that the launch date of an index typically happens after a period of superior performance. Then there's a bit of thought that goes into it, and then the launch happens. This is quite common for new indices. It's not popular within an index company to launch an index that has got demonstrated underperformance in the pre-launch period. So here you can see that the period over which you make comparisons is quite important as well. So you can see the back history with a period of outperformance. That's not available to real investors, but no evidence of post-launch outperformance by focusing on ESG stocks rather than others. So let me stop sharing with you and come back to you as a group. There's a few remarks on this business of evaluating companies, and I think this is the point at which I now hand back to Masha and let somebody else share their thoughts. I think you're muted.
Yes, just before I say anything, I will unmute myself. Just a quick question, because I know that Lauren wanted to respond to some particular points that you said, and Robert has a few things to add. But there is we have a question about, should governance not be a starting point for any rating system, as being something that underpins any business in the ESG context or otherwise?
That's a good question. With what I've got open at the minute, I can't see who the questioner is, but let me not respond on that. Traditionally, there was more of a focus on governance. And in a number of academic studies, it looked as though well-governed companies, as indicated by governance rating schemes like we've just seen, had strong outperformance. There was then a rush of asset managers and asset owners who were interested in investing in well-governed companies. But from that point onwards, there was no outperformance. People thought the governance was important. Prices had gone up to the level that reflected the quality of governance and how well a company was looked after in the interests of shareholders rather than simply managers. And the performance was neutral. Overall, we don't see very much in the way of difference between well-governed and poorly governed companies, socially conscious companies and those that are not. And that's in part because unless you're looking at a long period, what you see is judgments that investors have made and that's reflected in the price. So that's my answer on governance. It's not that governance does not matter, it's the governance matters that much that it's already priced when you buy the shares.
Great, thank you. So Lauren, just by way of a brief introduction from you, a few words, and then I know you have some burning topics to cover.
Great, thank you. I'm Lauren Smart. I'm the Chief Commercial Officer for ESG at S&P Global, which is a Fortune 500 company and one of the biggest financial service providers in the world. I started life post-academia, which was, I did my undergraduate degree in Archaeology and Anthropology, which is actually where I met Mata on an archaeological dig in Croatia on a Mesolithic gravesite. So post my undergraduate degree, I went into mainstream finance. At the time, as Elroy highlighted, there was not really a field that was ESG. It was quite a niche field called ethical investment. And so I went into mainstream investment, worked in fundamental equity analysis for a big American fund manager, was reflecting when it came the point to kind of go through the system and do your MBA, what do I want to do? And I thought it'd be interesting to explore some of my undergraduate interests. And so I worked at the Department for International Development. I did my master's in international development and anthropology. I was working on the Millennium Development Goals around girls' education, which preceded the Sustainable Development Goals, which gives you an indication of my age. And then I saw a little job advert in the Cambridge Careers newsletter looking for people with a sustainability background and a finance background to help to grow a business. And at the time, that was incredibly Jekyll and Hyde. It was extremely unusual to have both a sustainability background and a finance background, polar opposite. So I joined that business. It was called True Cost. It was a startup. We were doing climate finance and providing data and analytics into the finance industry around environmental issues. At the time, it seemed very, very, very niche, particularly like the climate side of things as part of so what was called socially responsible investing or ethical investing was very considered quite peripheral and quite esoteric in many ways. My parents spent many years asking me when I was going to get a proper job, which they finally stopped doing. I should emphasize. Anyway, we grew this business. We became a leader in the climate analysis and analytics space for the financial companies. We'd sold the business to Standard & Poor's in 2016. And since 2016, we've been sort of further growing and developing the business within Standard & Poor's. So it's been quite an exciting ride, but I tell you some of that story because I think in order to understand why there are divergences in ESG scores, it's useful to understand how we've gone from it being ethical exclusion. So it's like how to, I want to align my portfolio with my religious beliefs, for example, and therefore I can't have certain types of companies in there. I don't want contraceptives companies. I don't want any companies that do that lend money, for example. That was targeting a very specific outcome. But actually, what we've seen over the course of the 22 years that I've been in this industry has been that we've moved away, or should I say, expanded from looking just at the ethical concerns and approaches to exclusions, negative screening it's called, where you remove companies from a portfolio, to a process. So when I think about ESG, which we think about, it says environmental social governance, it doesn't actually say what you're doing. It has to be fixed to the word investing. There are as many different ways to do ESG as there are ways to do investing. And I very much hope that if I'm successful in what I do, there will be no such field as sustainable finance or ESG anymore. It will all just be finance and investing that takes into account environmental, social, and governance issues that were previously considered to be non-financial. But over the course of the last 20 years, we've seen quite clearly in the wake of the Enron scandal, that governance is clearly a critical issue. That seems almost crazy not to think of governance as a critical factor when you're considering the financial performance of a company, which I think was what the question that we got was kind of getting at. And similarly, now it's all the rage. Climate change is everywhere, and everyone has a much greater awareness of how climate issues affect companies and affect profitability of companies and affect how product portfolios will evolve in the future. But 20 years ago, that wasn't necessarily the case. In fact, I even had companies telling me it was good to externalize your environmental externalities, and that was putting onto somebody else's P&L. And similarly with social issues, I think in particular, the COVID crisis has highlighted the interconnectivity between people, planet, and profit, the way in which you treat your suppliers, the way in which you treat your workforce, the way in which you conduct yourself with a greater, as a business, with a greater purpose than just your shareholders, but all of the other stakeholders in your business, is something now that is beginning to be better understood by big businesses. And I think is again really creating that connectivity between ESG and environmental social governance issues being part of a holistic investment process, whereby you consider all the different information that might drive a company's performance, both now and in the future. So if we think about ESG as a process, then it's not targeting a particular specific outcome. There may be different types of outcomes. And I know something that Robert's going to come on to in a moment is, what is that outcome? So obviously there's lots of different ways of investing. If you want benchmark returns, which a lot of big pension funds would need to do, you need to have returns that are very close to the benchmark. You're not seeking outperformance, you're seeking to mirror the returns to the benchmark, maybe with less environmental social governance issues tilted away from that, but keeping the benchmark returns there. You might be wanting to seek significant impact. So you might be wanting to say, I don't mind deviating from the benchmark. Actually, what I'm seeking to achieve is positive impact, and I'm going to invest in a particular theme. So I'm going to invest in social housing, or I'm going to invest in lots of environmental technologies which are going to be critical for the transition to a low carbon economy. Those are likely to have much higher risk, much higher return potential, possibly. There's no rights or wrongs about which approach. It just depends on the investment strategy you're seeking. And maybe we can look at how that, if we look at it through the lens of a particular company, I think it will help to highlight that it's the information that you feed into the process that's the critical part, and asking yourself the questions and knowing what questions and what impact and outcome you're seeking, that's important. So let's think about Facebook, which had very different ESG scores on the E part from some of the different providers in the market. So the sorts of data points you might look at in order to assess the quality of the E would be what the carbon emissions of the company are. Now, carbon emissions of a company can be from your operations, or they can be from your electricity supply, or they can be from the products you have and the use of those products, just some examples. So something as simple as carbon emissions, you need to know what kind of carbon emissions, what the scope of those carbon emissions are. A business like Facebook has got a lot of data centers, which are incredibly energy intensive. So you might say, well, actually, this is a very energy intensive business and therefore strike against the E metric. Or you might go, well, actually, Facebook's got some incredible environmental programs, which means that, yes, it's got big carbon emissions, but it's also putting them in locations like in Sweden, where there's high renewable energy, where it's cold already. And therefore, it's the governance of the environmental issues is meaning that they are better able to manage environmental risks in the future that come from the type of business that they have. So those are different ways of thinking about it. Similarly, if you look at a company like Tesla, you could say, okay, we've seen some governance challenges with Tesla. Could say that for Facebook too. And so do we rate it poorly on an ESG score? Or do we look at the fact that the products are having a very significant impact in terms of the reduction of carbon emissions and therefore weight it highly? So a lot comes down to how you weight the E, the S, and the G, and also how you think about the different metrics that stack up to the E. So, and another example, just to highlight the impact and what you're seeking to achieve as an outcome. If we just, again, take something as simple as carbon emissions, which sounds extremely like quantitative, we can get our hands around that. There's lots of disclosure on carbon emissions from companies. So if we were looking at car companies, we look at, say, a traditional Porsche, and let's maybe look at a Tesla. We might be able to, and you might want to look at carbon emissions and go, what does that mean? Is this a good from an environmental perspective or not? So you might look into what goes into the production of that vehicle, and it might be that actually the Tesla vehicle's got very high carbon emissions, and the Porsche's got very high carbon emissions, and maybe they look comparable. You might look at the carbon emissions relative to the revenues. And for some vehicles, like a Porsche, whilst the carbon emissions are very high, the cost of the vehicle is so high that it looks like it's got a low carbon intensity relative to a lower cost vehicle. Or you might be looking at something like the carbon emissions relative to profit, in which case the Porsche is going to look pretty good because it's got high margins. Or you might be looking at it from the perspective of what are the alternatives? How many passenger miles can I travel in a Porsche? How many people can I take from A to B? And the carbon emissions associated with that mileage, in which case the Porsche is going to look very bad relative to, say, electric vehicles. So depending on the question you're seeking to answer, am I interested in carbon per revenue, per profitability, per passenger mile, then you're going to get different results. And it's not that they're right or wrong. It's just that we need to bring more knowledge to the market so that we're able to ask the right questions. And so investors are able to seek out the right match for their investment priorities and the impact that they are seeking to achieve. But I will pause there and hand back to Marcel.
Well, and now the head is properly spinning. And I can only imagine what it's like to be the senior bursar at Caius, at times faced with having to make decisions or ask just those questions. So Robert, what do you do?
Well, actually being the senior bursar at Caius is absolutely fantastic. I recommend it as a career for anyone. So to introduce myself, Robert Gardiner, I have a first career and a second career. My first career was at PricewaterhouseCoopers for 25 years. So I'm a chartered accountant. My second career was bursaring. I will have been with this college for 3 years come September. An interesting 3 years, half of which would have been dominated by dealing with the COVID crisis. Prior to Caius, I was a bursar for 5 years at another college. So to put it into the asset management context, I've been a representative of an asset owner for some 8 years now. My previous career has made me very sensitized to financial criteria, but I've never actually been a participant within the asset management industry. So I come basically with a few slides which are boldly titled. Now I just need to try to close some windows so I can organize and show you. Oh, I've just closed the wrong one. I will now try and share my screen. And I'm hoping that that's got the right thing on. Imesha, can you tell me, has that got the right thing on?
It has got the right thing on.
Good, right. So I called it the asset owner's perspective. Well, I should say it's an asset owner or this asset owner's perspective. And I'll try and reflect on how the college has approached various ESG related matters. So first of all, you have to decide what your goals are. And what Lauren said is hugely important there, because I mean, it is quite a bewildering array of things that one might or might not wish to do. So do you want to measure or engage? And I think that these two very important ends of the ESG spectrum as you fold that into your investment policy statement. Measuring is, if you like, keeping up with the Joneses. Engaging is trying to make the Joneses behave slightly differently. But exactly what are you going to measure or engage on? So first of all, we might look at the college mission. So this is learning, religion, education and research, and maintaining a college for students to study for degrees within the university. So does that mean you exclude X or include Y? So for example, you have many, an enormously strong tradition in medicine. So does that mean that we really feel that actually having tobacco stocks would be a difficult thing to do? In fact, we do have a bit of tobacco. We've got around about 200,000 pounds worth at the last snapshot. And I'll come on to why it is that it can be difficult to exclude things in a moment. Or do you want to include Y? Are there particular things that you wish to promote? There's one philosophy that says you invest in your competitors, but investing in other universities would be a trifle tricky. But really in the ESG arena, we're talking about, are you going to go for impact investment? particularly when it comes to the fossil fuel. So we have, although it's not within our mission, we obviously have beneficiaries who are more and more vocal on the idea of excluding fossil fuel. Or do you want to change Z, P, and Q? You know, choose the things that you wish, that you feel you wish to change. So, and I personally, I would put myself in terms of fossil fuel. I'm not a divester. I don't think that the divestment is as effective, or in theory, it should not be as effective as engaging and trying to change. So, for example, ensuring that fossil fuel companies can use their fuel knowledge and their energy knowledge to change to sustainable sources of fuel. So you have to decide that first. Then reporting. As an asset manager, as an asset owner, we give a discretionary mandate. We then need to monitor the performance of our managers in accordance with that discretion and the mandate that we've given them. You want to see that they're getting somewhere. And ESG, I think this is quite tricky and troublesome when it comes to engaging. Trying to get good reports on engagement can be quite difficult, particularly on the different types of asset management mandate you might have out there. And we've got two which are rather different style. We have one asset manager which is essentially takes us into other funds. So it's like, if you like, a fund of funds engagement model. And we have another one which runs its own fund. So it's as though we've got a slice of that fund. It's as though we've got a segregated portfolio, and there's very much more direct engagement there potentially with the underlying names that are invested in. So there's a great variety of determining what you want, and we've mentioned quite a lot of what's on this list. At the top of the list in the higher education sector is CO2, because that is what our beneficiaries are most concerned about. They are in the 18-25 age group. They are passionately concerned about it. So clearly that is something which we watch. We don't actually have an exclusion mandate. But I can say that out of a portfolio which is currently valued at around about 240 million, we have around about £600,000 in what might be termed fossil fuel investments. They are legacy investments, which are related to private equity investments. We are not expecting our investment managers to take us into fossil fuel because they consider it as basically a busted flush, stranded assets. And therefore the long-term financial returns, and we are looking for long-term financial returns, are not good from that sector. Executive pay, the gender pay gap, all required to file those these days, including the college. Board diversity, and diversity is a big issue within the college. We're looking at all ways to try to promote that at all levels, not only the admissions of our undergraduates, which are the most obvious element of potential diversity and wishing to create opportunity, but it's also important at the fellowship level and at college council level, at trustee level. Supply chain modern slavery is another growing issue. Environmental damage, I mean, could be up there with CO2. Transparency, I view this as being particularly important. I try to make the college transparent, as transparent as we can. And this one I've tacked on the bottom, mental health, because this is something which has arisen significantly since the COVID incident. A lot of people are under significant mental pressure, and in fact, one of our asset managers has a new program to identify companies and the way they approach the mental health of their employees. The mantra being that apparently £1 invested in mental health saves £5 of value lost, and so on. So there is an enormous variety. We've seen quite a lot of it in the presentation so far. So what do we do? As an asset owner, I think mandating the policy has been very difficult. It's been quite difficult to determine, actually, out of the organization here, what it is that people want, and getting engagement with with students and the fellows is sort of easy in some ways and hard in others, because when you present them with the bewildering variety of what could be done, it gets difficult. Everybody will shout fossil fuel, but there's so much more to it than that. So one could mandate the policy, but I have found a more effective way of trying to engage investment managers actually is when selecting investment managers, is to determine what the how ESG features in the balanced scorecard that one will generate in terms of selecting investment managers, as well as what their performance is, what their fees are, what their ownership structure is, what their stuff and personal turnover and pipeline is like, and all those other sorts of issues, whether they can report and give you what you want. Also, you want to look at what is their approach to ESG, and that is partly because certainly up until more recently, if you actually said, well, I don't want to be in tobacco, but I don't mind some fossil fuels, and by the way, can you make sure that we're voting no on every executive pay package, but actually I don't mind about gender diversity on boards, you can't get that, because or if you can, it will be at such cost that it will probably knock the provider out of the running. So I found it easier to adopt a policy and look as part of the balanced scorecard and the appointment of the investment managers, look for what their policy looks like and see whether it looks attractive and it fits your organization's likely needs. The development of the market recently has been huge, and I think that will likely change. I think there's going to be a much more on offer. We have to oversee our providers, our investment manager providers, and so we now receive and demand more information on what they're doing in relation to ESG, and with one of the providers, we're very closely engaged in developing what it is that we want them to do for us. So that's a little bit of an overview of what it looks like from this asset manager trying to navigate things. Very happy to take questions. There may be some in the chat or otherwise. I've been looking at the screen that I've been presenting to, but I'll hand back to Masha so I can have a look at those scoreboards and see what you say.
Well, there is actually a question that I think really follows on to what you've been saying. Excuse the sun, I haven't got a better blind here, so I'm going to be coming in out of light for you. Is how much freedom do you have, or how do you feel totally free and uninfluenced in your investment decision making from any outside or top-down pressures, targets, and so on? So I guess, what is the environment and context in which those decisions are made by the college?
Right. So is this one of the ones that is down on the? It's
in the chat.
All right. How does Robert feel? Totally free and uninfluenced in his decision making from any outside pressure. Okay. Well, it's important to understand how we calculate, how we put together the mandate that we give to our investment managers. So every year we refresh our investment policy statement. This defines our risk parameters and our investment return requirements. And it says a modicum, but not a lot, about ESG, because this is a phenomenon that basically we found it easier to adopt the policy from a provider that ticks enough boxes to be appointed, rather than actually to say we must have this or that or the other in terms of ESG. So I feel free and uninfluenced in asking the fellowships and the investment committee's opinions, and we put it together as a collegiate matter, as a committee matter, and we revise that investment policy statement, which then goes to the College Council for approval, and then goes back off to the investment managers. Most of it is formulated by the investment committee, and in terms of person who holds the pen holds the power, I draft it. I hope I draft it with the input, though, from advisors themselves as to what's achievable, and also informed from the discussions of the investment committee up to that point, and also the general input of fellowship, which is, even just discussions at lunch, if you like, just to feel the vibe of the place. Also, one has an eye to what the students, our principal number of beneficiaries and our principal financial recipients of benefits feel, because those are the people that we're here for, although they don't control us.
Thank you, Robert. I'm going to try and keep things as they're coming in. There was another question in the chat, and then Boya has their hand raised. So from the chat, Alan asks, can a truly ethical investor invest in pooled funds? Should they be avoided as a matter of policy, as one has so little control over what one is ultimately invested in over time?
Should I pick that up, Ben, because it's hugely topical, and I did mention that, and then didn't go on to discuss. I mean, the investment manager that we're working with is one such investment pooled funds. Now, there are some there's some interesting things there. So I know there's sort of 4 questions that I've been working on with them. First is, are they passively measuring, or are they proactively engaging with companies? Well, they can't engage with the company, but they can engage with the manager. So our issue is to ensure that their engagement with the managers that they're choosing is as productive as possible, because that leads to either amplification or dilution of the investor voice. So if I'm investing, 240 million, I'd love to have that personally, but it's hardly a drop in the ocean of overall assets. So if we have particular views which are either we espouse in terms of the ESG policy of our investment manager, or alternatively where we influence the investment manager's policy and they then implement it, they may be implementing across 10 billion, which still, well, it's a bucket in the ocean, it's still not the ocean, but it's much more influential. So I'm looking for amplification of our voice. The risk is with funds of funds is you get dilution, because unless the underlying funds can be engaged, then you get dilution. Reporting is much more difficult because it's one step removed. So yeah, that point about pooled funds, you've got to vote on the voter. You haven't got the vote itself. Also, it does make the ability to exclude more difficult. So if I said, I'd prefer not to have any tobacco, then I'm not sure they do have 100% dominion over whether or not tobacco does or doesn't appear. So I think that I've got significant sympathy with Alan's question.
I think this is an important issue, what you delegate to the managers and what you don't. And within the investment committee, there are very interesting dynamics. Robert has a bigger say in what gets discussed. He doesn't control the discussion, but what gets discussed. And a good committee is one that has people who don't agree from time to time, but nevertheless one has to come to a conclusion. And I've now been involved for a number of years, and there are quite a number of cases where there will be somebody who takes a view that the policy of a current or a potential manager is unappealing, even unacceptable, and will express that view. Others will express a different view. And in the end, we need as a group to reach a conclusion. Robert's very good at pulling this together to help us reach a conclusion with a degree of cabinet responsibility. But we don't forget what we said. So this process of taking account of your individual preferences is one which, even within the confines of one committee for one fund, which is one of many that the manager is dealing with, is quite a vigorous source of debate. When it comes to pooled vehicles, well, investment management is a business, and clients also want economies of scale in the fund in which they invest. So there is a coming together there. We have one manager that caters for different tastes amongst different subsets of clientele, so offers 2 varieties of an otherwise similar fund. but you couldn't expect there to be a huge number of pooled funds, and you wouldn't want to be investing in a segregated fund which has the lack of voice that Robert was just describing.
Very, very good, thank you. Well, Boya has their hand raised. You can unmute yourself if you would like to ask the question directly, or you can pop it in the Q&A. Yes, I think you can speak now, Boya. I'm afraid we can't hear you. You are unmuted. Oh, Boya has disappeared. Right, while Boya sort themselves out, Peter Keir, would you like to ask a question directly? Just unmute yourself. Or I will unmute you. I can't. It should be in the top right-hand corner of your screen, a little blue box in which you can unmute yourself.
You've got a little bit of chat there from someone that can't see the mute button. Perhaps it needs a bit more of an explanation. So there should be.
I think, Boya, can you speak now?
Oh, hi, can you hear me?
Yes, we can hear you.
Oh, no, sorry for the disruption. So my name is Boya. I worked in Cambridge before as a postdoc, and after that I moved to Oxford Business School as the lead of a quantitative research team, looking at how ownership structure affects ESG performance. And now I'm working as an economist for the United Nations. So I just would like to share some of my opinions, from the perspective of ESG methodology and also societal impact on this matter. The one thing I want to raise is that about the rating or the reporting of ESG, because it really matters about what kind of ESG measurement we're using. As we know, the Bloomberg ESG actually has very low correlation with the ESG measurement developed by, say, Thomson Reuters or Sustainalytics. So sometimes when you choose one of the socially responsible companies, it might not be considered as such based on another ESG matter. And also from the construction of the ESG measurement, it's highly formality-based, meaning that you're looking at the absence or presence of particularly procedures, framework, rather than looking at the actual impact. And in fact, we found out that some of these companies with really high ESG performance, they are not necessarily in reality socially or environmentally responsible. So when we look at the outcomes of the ESG measurement, so we might have a very different story. The other thing is that from the societal impact perspective, the increasing organizational complexity, say multinational companies, create a really difficult problem in terms of detecting socially or environmentally irresponsible behaviors. For example, in my focal region in the United Nations, we have received lots of human rights reports about the low wage in the garment sector, especially the gender pay gap in the garment sector between men and women. Some of these companies are actually related or outsourced by many multinational companies. And obviously, they're not part of the company corporations. So these kind of business practices are not reflected in the company's statement, and therefore they're not reflected or indicated by the ESG scores. So I wonder, as in pursuit of like really socially responsible investment, I mean, I think like we need more engagement and endeavor to detect and engage with the invested companies. Thank you.
Well, Lauren, it's your turn.
I think, I mean, to respond to some of the broad sentiments there, I think that going back to my point around ESG is a process by which you can integrate environmental, social, and governance issues into your investment process, seeking different outcomes. So some investors aren't seeking the most socially responsible companies in the world. They're seeking to mitigate downside risks from the least, being exposed to the least socially responsible, or the ones that have got the greatest risks, financial risks that are associated with ESG issues, which is different to seeking companies that have a very positive social responsibility performance. So I think it kind of goes back to, you need to match the process that the investment manager is taking and the information that they're factoring in into what outcomes you're seeking and what you care about. If you care about it being socially responsible companies and you're prepared to take significant deviation from the benchmark, then that's very different to wanting to mitigate downside risk and having benchmark returns. So I think that, you know, as the market evolves, we will see a greater understanding of the different types of approaches. And also, I mean, one of the key things which is interesting when we look at the regulatory environment within Europe in particular is efforts to create more comparability in the ways in which companies and investments are reported. So there's some legislation called the SFDR, which is basically saying these are the most important issues that companies should be reporting on, and that investors should also be reporting on in terms of the exposure within a portfolio, and this is how they should be reported. So creating some consistency so that you're not looking at an aggregate ESG score, which has got weights and materialities, but looking at a fixed number of underlying metrics that you're not having to unpick. You can see, so this is the carbon emissions, or this is the gender equality within a particular fund or within a particular company. And then similarly, the European Green Taxonomy is seeking to say, well, what is green? What counts as green? Sometimes it's obvious, but sometimes it's not. You know, large scale hydro can sometimes have social issues associated with it. Early stage social solar panels had all sorts of environmental issues associated with the disposal. So by creating taxonomies, it makes it clearer for investors in what's green, what's not green. And also it makes it clearer for the buyers of funds to have comparability when they are looking at investments.
Thank you, Lauren. There is, just going back a little bit to the questions of divestment and similar, Alan is asking, I would ask whether real engagement with carbon reduction does not mean divesting not so much from those who mine or produce fossil fuels as from those who burn them.
I'm happy to take a stab at the approaches we see in the market. There are lots and lots of different ways in terms of reducing carbon exposure or the transition, aligning an investment portfolio with the transition to a lower carbon economy. And there is not one single approach. So there are some of the biggest pension funds in the world, some of the Dutch pension funds, for example, who take a transition-based approach. So one of them has a carbon budget that they assign their portfolio managers, and then they tighten the budget over time and you reduce the carbon emissions associated with the investment portfolio over time. At the same time as investing proactively in different asset classes where you can directly invest in solution providers. So that's one approach. There are other pension funds, and I'm using pension funds as the analogy because there's been some very interesting work that's been done in differences of approach, seeking the same outcome, which is a lower carbon economy in the future. Some will exclude fossil fuel companies from the portfolios, and there have been regional slants to that. But there are also many big pension funds who say, well, actually, we need to have a very broad diverse portfolio of assets. We're universal owners. We need to own the world in order to, or the majority of the financial markets. And so actually what we need to do is to encourage companies to evolve in the right way. And actually in order to transition to a lower carbon economy, we need to have the flow of capital still going to those traditional energy companies, but those traditional energy companies transitioning. And so we need to engage with companies, and by divesting, we remove our seat at the table. And some of the biggest pension funds in the world CalPERS, for example, springs to mind, say that it's absolutely critical to achieve net zero, but to achieve net zero, we do not want to give up our seat at the table and have our voice. And I think this comes to Robert's point about amplification. And then and then there are others that have taken in between approach, which is we will divest of companies unless they can prove, energy companies, big traditional energy companies, unless they can prove that they have transitioned. So it's a kind of combination of approaches, but they're all seeking the same broad outcome over the longer term, which is to have net zero or Paris-aligned investments, and to mitigate downside risk in the transition to a lower carbon economy. So there are lots of different approaches. And just to put another kind of level of complexity on it, when you say fossil fuel free, it sounds simple. But when we look at a company, does fossil fuel free mean that the company doesn't use any, doesn't burn any fossil fuels in the production of their products? What about their electricity provider? Can they burn fossil fuels in the production of their products? What about the ways in which the products are used? Do they require electricity, or do they require fossil fuel combustion in order to operate? And then you go through the supply chain. So like, does that mean that that company, if it's truly fossil fuel free, it's not just the electricity provider that they use that has to be fossil fuel free, but is it every other provider? So it actually becomes quite a challenging situation in terms of putting circles around precisely what is fossil fuel free. And is it just fossil fuels, or what do you think about nuclear? That again has significant regional question marks over it, depending on what your political persuasion is and how you see nuclear fitting into a low carbon transition. So just to flag this, it's definitely not black and white. There are many different ways to achieve the same outcome, the same goal, and different tools at your disposal.
I think it's worth bearing in mind that some investors have different values from other investors. So let's take extreme cases. If, as was the case when I was involved with another investment committee, you're investing significant funds on behalf of a cancer charity. If you lose money by investing money into tobacco stocks, that's bad news. But if you've made money out of investing in tobacco stocks, that's also something which people would feel very uncomfortable about. If you were investing on behalf of a dharmic charity, Hindus, Buddhists, and so forth, you will automatically be underweighted in pharmaceutical companies, because pharmaceutical companies, in many cases, test on living creatures. That means you'll probably be overweighted on financials, which is another big sector. If, on the other hand, you were a Sharia-compliant investor, you would be underweighting financials, and you've got to find somewhere to put more. So for the investment manager, I think it's a matter of understanding what the values are of their clients. And we're no longer in a world where one size fits all. It's challenging, but I don't think there is a right answer, but there might be a superior answer for a particular client or a particular asset owner.
Thank you very much, Elroy. I'm going to swiftly move on to the next question, which is, Robert, directly for you, and you might have already seen it, but I will read it for the benefit of everybody else. Rufus asks, given the long-term nature of an endowment, how does the college think about ESG impact of alternative asset classes outside the listed corporate markets, timber assets, social housing investments, etc.?
Well, the answer is that we have some of those things. We certainly have, well, corporate markets aren't particularly good at providing a lot of the alternative energy source in investments. So actually, we've got some of those through private markets. Timber and social housing specifically. Well, one thing we haven't touched on is that the role of property, and the college does have about 35% of its portfolio invested in property assets, which is largely a fascinating and random mix of assets from the last 670 years. So there is land there, and we look at certain elements of it with our advisors, Bidwells, about biodiversity, alternatives. I've asked them, is any of this land suitable for planting timber? And you get some fascinating responses, and that timber is not always a good answer. They are developing their team. They are, I think, already leaders. The person who specifically advises the college is enormously knowledgeable in conservation matters. So we're looking at that. But I don't know that it's ever likely to be a very large proportion of our property activity, to be honest, given where it is and what it does at the moment. Social housing isn't something which I've looked at specifically. Although when I read your question, I did wonder, yes, poor people who need housing. We've got about 1,000 of those. So there is, of course, plenty of student accommodation, all run at a loss. Yeah, I think these are things which will more and more feature as alternative sources of return and alternative sources of ESG goodness, if one can work out what is good. I hope that gives you a little bit of an answer on that point.
Thank you, Robert. I'm conscious of time, but we still have got some questions coming our way. So if you're happy to take them, it would be good to carry on the discussion. It's obviously a fascinating topic. Ryan asks, if ESG ratings do not capture impacts outsourced to third parties, e.g. Facebook's ESG rating may not take into account performance of its contractors, would an increasing emphasis on ESG in investment portfolios actually incentivize outsourcing of harmful businesses to regions with the least regulatory rigor and transparency?
It could, is one of the answers to that. A simple, quick answer. So increasingly, supply chain emissions and supply chain impacts are having, that's a source of focus and a growth area in terms of where data is sought, but it's harder to get hold of if you think about how you would go about doing that even just for yourself as an individual, to understand everything you buy and the carbon emissions associated with everything you buy, and then the carbon emissions associated further down the next layer of the supply chain. It's not an easy thing. Having said that, I think it's an area where advances in technological approaches to collecting data will be helpful. So there's all sorts of approaches through, AI and shipping data, satellite imagery that are beginning to shed more light onto the potential supply chain risks. And also the more supply chain mapping that there is done, the better as well. And also something to consider when you're looking at the greenness of sovereign bonds. So is a country green because it's got great green policies and it doesn't have high carbon emissions, but actually it's just outsourcing all of its high carbon activities to other countries, which is particularly the case if you look at sort of OECD versus developing countries. The industrialization has been outsourced or off balance sheet, depending on how you want to look at it. So it's certainly a risk, and it's something that needs to be assessed and addressed through greater data transparency and through better disclosures across the board.
Could I add something to that, Masha?
Of course.
That if people don't like the idea of this college owning companies that look on some criteria irresponsible, then there's a simple solution. You sell them to others who, as Robert was pointing out, may not care so much about the challenges that sort of ownership poses. But I think over the last year or two, it's gone even further. If there are types of companies that everybody dislikes, you can't eliminate those companies, but you can still have everyone selling them. The buyers will be private equity. So a number of fossil fuel companies, for example, are no longer owned by stock market investors. They're owned by private equity investors. Lord knows, in some of the non-transparent holdings that some investors have, some of them will be receiving back at very high fees the stocks which commanded very low asset management fees when they were publicly listed. So it's a funny world. You've got to be careful what you wish for in all of this, and just selling shares you don't like should be done with thought.
Right, well, I think we're coming to the last question, which if the technology cooperates, Vivian will be able to ask directly. You'll just have to unmute yourself, Vivian.
Thank you, and sorry for being, you know, a little bit contrarian or whatever in my approach to my questions. My question really is to anybody who feels like answering is, I can understand how responsible investing decisions are conditioned, if I may say so, by some checks, putting things through certain hoops. Does it pass this test or that test or whatever? But I wondered really how much weighting is perhaps given to intention of that entity, that organization, whatever, in a way, almost no matter what their efficacy is, if there is a possible upside. And I say this really thinking about as someone who's representing a small charity, etc., and who's a kind of terminal do-gooder and an arts graduate and not very well versed in all these things. But I do seem to see that sentiment in the markets is an enormous factor. Maybe that's something one should not consider Robert Gardiner in the longer term, but it does seem to be very effective. And some things are vogue, some things are fashionable. And if you have good intent, is there some consideration given in any weighting, in any decision, to not just the fundamentals as one defines them or are defined for you, but are left in the kind of saying, well, this maybe is a good, responsible, and there is a way to go here. Sorry, I haven't expressed myself too well.
Well, I think perhaps I can respond with some specifics. And I think this is engagement, but I think you're also talking about a plan to engage, if you like. Or are companies susceptible to engagement so that they can be persuaded to do something better than they've done before? And the reason I said I might be able to deal with some specifics is that I have a report from one of our managers here, which indicates what they've done in the last quarter. And they provide some voting detail, and that is where the rubber really hits the road, particularly with directors who might get shifted off the board. So this report says that the manager didn't support 13% of the resolutions proposed by management. So that shows a measure of disaffection with what they're proposing. There's a particular proposal, a particular report on rejecting the remuneration report for a very substantial US organization. There is also a statement on the way that votes for the re-election of directors will always be rejected if they don't have adequate diversity in the board and also the senior management. So not only at board level, but also the sub-board level. And so is there a pipeline of women, ethnic minorities to the location of the company, etc., coming through. So those are practical instances where engagement can persuade or even force better behaviour.
Thanks. I would totally agree, Robert. And building on, it's a really interesting question. Actually, I've had this debate before. If you create the impact without the intention, is the impact the same? I think it comes into particularly stark relief when you're looking at the Sustainable Development Goals. So if you're measuring your portfolio's alignment with the Sustainable Development Goals, you might find out incidentally that you've got the investments that you have are reducing poverty or having a positive impact on forests or whatever the particular SDG is. You might go, oh, that's nice, that's a positive impact. Having said that, if you don't have intentionality, then how are you going to move the needle and keep progressing in the direction of having a positive impact if it's incidental? So I think, going back to Robert's point, having the intentionality enables you to have an active strategy where you are actively trying to move the dial and move forwards, rather than incidentally finding out that you happen to have alignment and reporting on that. So it gives you that longer term ability to influence. And additionality is something else that's being looked at a lot more in terms of particularly environmental investments, but also accounts for social. So if you're doing something and it has a positive environmental impact, like you've changed all your light bulbs to special light bulbs, then that's great. But actually, if that's what the regulatory requirement is anyway, then you're not creating any additionality. So how you can have the biggest bang for your buck and create the most additionality to what would have happened otherwise as BAU is something that's increasingly important. And it's an extremely good question, because there's a bigger focus on that going forward.
Well, thank you, Laurel, because it would seem to make you less of a profiter and more of a player and an influencer and a game changer. And I think we need that.
I would agree.
Well, I mean, I'm not at all surprised that it is now nearly 7:20, and quite a big group of diehards are still with us. But I'm very mindful of the time that you were all very kindly given this afternoon. So I would like to thank Robert, Lauren and Elroy for starting off and continuing a really, really interesting discussion. It feels that we could go on for quite a long time, and maybe we will come back to it at some point in the future. It's a very exciting and ever-changing area. Thank you very much to all of you who have joined us.